As you know, many of the companies that I engage with, it's their goal, an exit dream of theirs to go public. And let's say, for example, a company was to go public on the London Stock Exchange, for example. Does that mean that an investor in the US can buy shares of this company?
It's a great question. And the answer is maybe. If a company is listed on, say, the London Stock Exchange or Frankfurt Stock Exchange, it doesn't mean that they have to register their shares with the SEC. In fact, the whole point is they're now registered and controlled by the home market, in this case, the UK.
Okay.
Now, investors in the United States may not have access to those shares for a variety of different reasons, because under U.S. law, which is both federal and state, getting access to a foreign stock exchange requires you to go through quite a few hoops. So if you're a big institution, you can probably, yes, you would probably have an ability to buy shares through the UK register thing. But let's just say you're Joe Average and you're sitting in your basement doing day trading in Florida and you're using, some, low-level broker-dealer. The answer is probably no. They can't do it. Right. The workaround, if you want to call it that, is there's ways for foreign as in not U.S. public companies, to get their shares quoted so that they can be purchased or sold, i.e. the order execution happens on the U.S. side and it's directed back to the home market, in this case the London Stock Exchange, for execution. So, I don't know, does that answer your question?
Yeah, that's amazing.
It's amazing.
But how does that happen? What's the process?
So in the U.S., obviously there's the big boards, which everybody's heard of, the New York Stock Exchange, right, the NASDAQ, those are the two biggies, right? But there's also this other market. It's called the over-the-counter market. And essentially, it's not a listing. It's not a regulated market. It's an over-the-counter, it's a marketplace. And within that marketplace, for certain qualified foreign public companies, companies that are listed on an approved foreign stock exchange, one that the SEC and the regulatory environment in the U.S. respects for having integrity, you can go through a process, and it's called an OTC sponsorship process to get those shares approved for quotation in the United States. And so essentially, you would need to go through a checklist to see if you're eligible, and the process typically starts with an inquiry with somebody who has the ability to sponsor you. And basically, there's a certain number of firms, there are law firms and investment banks throughout the world that have been designated as approved sponsors. And then they simply go through the checklist, confirm that you meet all the eligibility requirements, prepare the application, sign it, send it, and then you have to wait and see if your application is approved.
Wow. I mean, that sounds all very straightforward. But how does this compare with going through the front door route by, registering with the SEC, for example?
Yeah. Okay, so that's a good question. So there's a lot of fear of U.S. markets for a variety of reasons. So if an issuer, let's say it's a UK issuer, decides, hey, we, for whatever reason, we don't want to list on the New York Stock Exchange, we don't want to list on NASDAQ, we just want to list on the UK, they have to, quote, go public and register the shares and go through the process of getting approved by the UK. Now, if they decided, for example, that they now want to get a dual listing with, for example, NASDAQ or New York Stock Exchange, they would then have to go to the SEC, the front door, and basically file on the SEC's documents a registration statement, which is a very detailed disclosure document, and file that with the SEC. It would be reviewed, it would have to be approved, it would have to include all the relevant disclosures, and it's a big process. It takes a lot of time, a lot of legal fees, and so that's what you would do then is you are now technically a reporting issuer in the United States. And there's a
That's,
couple different ways you can do it.
that sounds like a very expensive process.
It can be pretty expensive, yeah, that's true, and it can be very time consuming. And there's both the initial expense, but then there's the ongoing expense because now you're a reporting issuer. And depends on whether you're what's called a foreign private issuer, which means you get streamlined reporting, or whether you're a full-fledged issuer, or, reporting issuer with all the bells and whistles. But in either case, yeah, it's a relatively big undertaking and it's a big responsibility. And lastly, it does mean you're subject to U.S. regulatory oversight and jurisdiction and liability. Liability.
Wow, none of us want that. I mean, so when we think about the OTC process, it sounds like a much more streamlined and smoother process to actually have access to US investors if you are a company that's listed in the London Exchange, for example. So if a company is eligible, let's say an example, one in the UK is eligible for this OTC process, I mean, what would stop them from going ahead with it?
Inertia, laziness. I don't know. I honestly, it's pretty easy to do if they meet the eligibility requirements. Right. Because all you really have to do is be in compliance. You have to first of all be on an approved exchange, which obviously the London Stock Exchange. You can go quite a bit lower. There's lots of other second and third tier markets.
Yeah.
So, there's many approved foreign stock exchanges that meet the basic requirement.
Right.
Okay, but once you get a sponsor application in, you have to pay what's known as the OTC fee, $23,000. There's some other miscellaneous expenses. You got to pay the sponsor fee,
right.
Which is, like I said, can be done either through a law firm or through an investment bank, and that's about it. Now, the beauty of this is within your home jurisdiction, as long as you're filing those periodic reports, and this is the catch, they have to be translated into the English language. Mm-hmm. Well, it's not a big problem in the UK, but let's say you're in Germany. Right. So you would file them in the German language, and then you would have a translated copy in the English language. And then once you've had this approved, when you file those documents with your home market, say the Frankfurt Stock Exchange, you would at the same time file it with the OTC,
right.
And then those documents become publicly available really at the same time because it's all electronic. I mean, it's like CCing somebody on an email. Not quite that simple, but sort of the same concept.
Okay.
And then boom, you have investors in the United States who have access to be able to place orders, so it's quotations, and that's both retail and institutions. That order then gets ultimately fulfilled in the home market. So it's kind of a no-brainer.
Wow, I mean, Brad, you make it sound so simple, and you say it's a no-brainer. So, I mean, what would you say the key benefits are?
Well, if you think about a public market, it's all about supply and demand, right? So if you have a limited supply of your stock, your shares, and you then increase the demand for the shares by opening it up to a wider market, by definition, you would expect that liquidity would increase, and indeed it does. So studies have been done that show that on average, this can result in an increase in liquidity both in your home market. Now that might be counterintuitive at first. It's like, what? Why would there be more liquidity in my home market?
Right.
Because U.S. investors are buying and selling the shares. The reason that the liquidity is increasing in the home market is those orders are directed back to the home market.
Right.
That's where they're fulfilled. So there's more liquidity. Liquidity is a good thing. Why is liquidity a good thing? Well, there's lots of investors who might want to have a bigger stake, institutional investors, but they fear that they can't unload the stake without having a negative impact on the price.
Right.
So the more liquidity, the bigger the blocks of shares that can be purchased or sold without impacting the price. So the liquidity in your home market increases. Obviously, if you have demand in the U.S., liquidity in the U.S. market increases. And then, not surprisingly, studies show that on average, there's an increase in the market cap, the basis point valuation, because essentially it's just Adam Smith's supply and demand By having more demand, you go further up, and on average, you will generate an increase in the market cap, the basis point valuation of the company. So those are all good reasons to do it.
Very good reasons.
Yes.
And I think if I was maybe a CEO of a company that's a public company in somewhere that's outside of the UK, this is somewhere outside of the US, this is certainly something I would want to consider. So Brad, I mean, this OTC process sounds too good to be true. There's a lot of upside for any public company that wants to take advantage of this. But what are the downsides?
Good question. I would say the biggest downside is fear.
Okay.
The U.S. is known, and rightfully so, as a highly litigious culture, and the securities laws are enforced both by the regulators and, importantly, by the private plaintiffs' bars. There's lawyers out there swimming around like sharks.
Right.
I mean, literally, looking to sue somebody, and that's part of the environment in the United States to ensure that people meet their obligations. There's the regulatory stakeholder, but there's also the private plaintiffs' bar. And so there's a fear that, there's going to be like a class action lawsuit because I materially omitted or misstated something. Okay, fair enough. That's the fear. If your shares are quoted on the OTC, but you haven't registered with the SEC, that is to say, go through the front door, file a registration statement, your liability is significantly lessened, right? Because you haven't agreed to submit to the jurisdiction of the United States. The fact that you have some trading activity that is happening by virtue of demand coming from the U.S. market doesn't necessarily mean that you've submitted and consented to the jurisdiction of the United States. So it's not as big of a risk. Now, is there any way that you could be forced to register?
Right.
And that's a legitimate question. And the answer is, it's possible. And the way it could happen is, let's say you start off and the amount of trading activity in your home market starts off at 95%.
Yeah.
Doesn't seem unreasonable.
Yeah.
And then all of a sudden, the Americans are just loving you, right? And you might also have trading activity in other jurisdictions, Brazil or Australia or something like that. If you get to a situation where the trading volume in your home market, let's say in this case the UK, is now less than 55%. So you've gone all the way from 95 down to 55, i.e., actually there's a lot of trading activity happening outside. Like I said, at least 45% happening outside the home market. And if the trading activity within your stock is more than 20% inside the U.S., so it doesn't have to be that, it could be 15% in the U.S., you're still okay. But if it now looks like, you really are no longer just a UK issuer, and now you have substantial trading volume, i.e. 20% or more, then that would require you, actually what you would do is you would lose the exemption. Okay, and typically that would mean you would have to register. You would have to find another exemption other than what's called Rule 12G32B. And it's not impossible with a clever lawyer that you can find another exemption. But in general, in that case, you could have to register. Now, has it ever happened? Very rarely. My understanding from talking to the OTC is a handful or less. I mean, but you also have to say, is it necessarily such a bad thing?
Right.
I mean, because the good news is there's a lot of people who are loving you over there. On the other hand, if you do commit securities fraud, then that's a bad thing. So I would say on balance, it's a good thing, but there is that risk, and that's the trade-off.
Okay. So in one way, the OTC markets allows you to have exposure to US investors. And if it turns out that the demand is incredible and trading in your home market diminishes somewhat, then that's not such a bad thing. But although it will be a process where you will need to register and list with the SEC.
Yeah, I mean, the capital markets are global. Apple didn't always just sell iPhones in America. Or maybe, I guess I should say, they started there.
Yeah.
But now a majority of iPhones are sold outside America. So think of it the same way with your stock.
Okay.
If all of a sudden there's great demand for your stock and it's global, is that a bad thing? I would say probably not.
Right.
But long and short, it happens very rarely. And given all the other benefits and the relatively modest expense and effort, and frankly liability, for most issuers, I think it's a no-brainer.
Brad, it's been a pleasure. Thank you so much for your explanation of the process and providing invaluable insight into the process for non-US companies to have their shares quoted in the US. Now, Brad, I tell you, I speak to so many entrepreneurs from all around the world, and their number one goal is to go public. And for some of these companies, they actually achieve this goal. Now, they go public and they become what you might consider a local hero. But I can tell you, after having conversations with them once they're there, you can become a local hero in your hometown. But they always wonder, what would it be like to have access to the largest capital market in the world, the US? And if they had a way to achieve that, I'm pretty sure they will take it. If you'd like some more information on how you could have your shares quoted in the US, then click the link below and get in touch.